Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. All right, we're back. What's going on, Paul?
What's up, everybody?
Man, it feels like we've been talking for like an hour. We just now decided to hit record. Like we're talking, and then we're like, all right, you ready? Yeah, I'm ready. You ready? Yeah, I'm ready. All right, record. Let's go.
Let's do it.
Yeah. Can
I
only talk
noticed
for so long.
the lovely artwork back there.
Yeah, it just showed up in the mail. I haven't. I gotta wait for Hannah to get home before I hang it because I don't want to make that mistake and hang it without the direction of.
Yeah,
how
you need
exactly to
parental
hang it.
consent
I do,
to hang that thing.
and I don't have it yet. So I just propped it up there for now. But yeah, I'll be doing that.
Good.
So
Yeah,
that's coming
cool.
together, pretty much complete.
Can you
here.
tell people what it is? Because they may not be able to tell.
Oh, it's a lighthouse in a storm, like a sea storm. It's pretty cool. I don't know. I think it's cool.
Yeah, I could see the light coming out of it and stuff.
Yeah, cool picture, cool metaphor. But yeah, you commented kind of like our investing strategy lately. You know, we got some storms going on around us, and some things we've done, but we've always got that lighthouse, that life insurance cash value that's there, kind of guiding us through, which is pretty nice to have, pretty nice to rely on. So
Yeah, it's a beacon, right?
yeah,
It's like the North Star. I can always kind of, if I can find it.
you can count on it, right?
count on
You
it.
can count on in your financial
Yep.
life.
Yeah, no question.
Yeah. So you need a lighthouse in every area of your life. Financially, for us, it's obviously infinite banking because it's something we can count on. We can plan on it. It's always going to be there working for us and keeping us, really does help keep us safe. Like creates safety, guarantees certainty.
Yep.
And it kind of creates, kind of highlights, I mean, that you put lighthouses around where there's land, obviously, because it has to sit on something. And it's saying, hey, there's rocks here. Don't come this
Yeah.
way. Right? So it kind of
Yep.
works like that too. You know, kind of fending off some stupid ideas or some risky things I might be doing with my money, and saying, hey, take a second. Look, and do you really want to do that?
Yeah, I had a similar conversation with a client just today over text, and I kind of wrote him this. I said, I'm of the same mind, not when it comes to some things, but certainly other things when it comes to financial decisions. I said the best investment I ever made was in myself, and frankly, that's part of the essence of IBC, self-reliance.
You're right. IBC is investing in yourself. It's paying yourself first. But you're
Yep.
right. Like the best investments, the only risks I've ever taken that have really paid off have been ones that I've taken and I've bet on myself.
Yeah, and you took a big leap a few years ago now, or a couple years ago now, I guess, when you left the airlines for good. You left your W-2 job, which is kind of like it's a whoopee for most people. It's a cushion because becoming an entrepreneur is, there's no just magic ATM that's just spitting out a paycheck. It's
Right.
It's all on you, and you took that big risk, and it's paid off, right? And I think that's partly mindset, right? That we learned from one of our mentors is that any successful business is not generally a side hustle. It's I
Right.
consider myself somewhat lucky that I started this on the side, and it's become my main focus in life, pretty much. But it doesn't always work like that. But you have to treat it. I think you have to treat just like your financial world, right? Your investment strategy, your retirement strategy. You have to treat it as it's a very serious business because it is.
Right.
And when you and I have ceded control over certain things, that's when things get a little murky and a little worrisome, right? But paying premium, I've got this stable this stable lighthouse, this warehouse of wealth that I can always come back to, and I can find it. It's there, and I know what's going to be in there. So
Yeah. Yeah. And you and I have talked a lot lately, kind of offline, about our approach to investing, and how, man, we've kind of turned the corner where we're very, we're very much thinking more conservatively, less
yeah,
private lending, less investing in, even though you do control the terms on that,
sure,
ultimately there's third party performance involved. That person who borrowed the money has to perform to be able to repay that loan, right? And the
yes,
interest on the loan. So there's third party performance, which invokes risk. Um, so we got some good advice that if you focus on what you're good at and you make money and you save it, at some point it gets easier to save a certain percentage of your income. Like right
right,
now, ideally everybody could do 10%. With inflation and Bidenomics and everything that's gone on the last few years, that's a stretch for a lot of people because life is expensive, man. It's just you can make 150,000 right now and you're barely squeaking by, right?
right.
Trying to raise a family and save and invest and do all that stuff.
Especially around here, where like in the town that I live in, a decent home that needs to be updated still is 700, 750,
Right.
and
Yeah.
it's going to need another 50 to 150 to put in it to get it to where it's, in the year 2024 and not 1988 or something.
Yeah.
And
So
that's just, so yeah. So 150, right, that's a
it's
stretch
not
for
going to
that.
cut it. Yeah.
No, it's not.
Right. So, but as your income increases over your lifetime, you get through your 30s, maybe you're in your 40s, and you still get your prime earning years ahead of you. As long as your lifestyle doesn't creep up, that lifestyle creep
Yep.
and Parkinson's law, then ideally you should be starting to save more than that 10%, 15%, 20%, man, 30%. That's that. And if you could save 30% and put it towards a policy or a series of policies, there's probably not a whole lot else you actually need to do.
Yeah, and we've had that conversation recently, and I'm I'm more and more of that mindset as time goes on. We're both going to turn 45 this year, and we've had a level of success in our businesses, in our joint business, and some other things, and that's nice. So yeah, the appetite to cede control over my capital when it's doing just fine. In fact, Tammy's premium is due tomorrow, and I've already paid it, so you should see that notification tomorrow, right? You'll get
Yep.
paid a little bit,
I've got one of mine due on
and
Thursday, 2 days from now.
yeah,
So yeah.
yeah, and I know the cash value is set to go up, and I actually took a picture of her stuff this morning, and I want to see what the net cash surrender value is once the premium has been delivered and it's it's in there, to see what the jump in the overall cash value is immediately, like right away, or when I say right away, I mean within 14 days of
Right.
the check clearing or whatever.
Yeah.
And I know it's going to be at least $19,000, so 15,000 turning into 18 or 19. We usually don't talk numbers here, but that's a real
That's
number.
pretty exciting.
And my goodness, that's about, if it's 15 and 19, I think that's about 25% or so.
Pretty much.
And people were just baffled by that. They can't understand how that works, how it's whole life insurance, how it could be this good. And they just don't know understand the relationship between death benefit, cash value, the inner workings of law of large numbers, and just how it all works.
Yeah.
And it's a darn shame, but yeah, get excited to pay that premium. And this kind of maybe dovetails into our IBC in action segment this week.
Yeah. So let's talk about that. We're actually going to use Paula as an example of IBC really thought in action right now, because you haven't actually taken the
Nope.
actual
Right.
step to get it done. But yeah, planning.
Yeah. So we've talked about convertible term opened up a large convertible term policy on myself back in November so that I could create, not only get closer to that human life value, but also make it easier for me to, if I want to convert some of that term into new dividend paying whole life policies designed for the infinite banking concept. Okay. So this is kind of an expanding the system. And this is folks, thinking ahead, thinking not just next month or next year, but what's happening in the next 24 months, 36 months, 60 months, 5 years, 10 years. What am I expecting any windfalls? In fact, I spoke to a prospective client today who owns a life insurance policy on her 80-year-old mother. And she just, since listening to us and talking to another client, just redirected the dividend to PUAs. It's an old Prudential policy. I think they used to be mutual way back in the day. Anyway, so that's going to make that policy bigger someday. So when mom does eventually pass away, it'll be bigger. Anyway, getting back to my story. So I've been thinking about these future windfalls of money and how I can best capture those windfalls. And I'm expecting these in the next 6 to 12 months, and how I can expect to incorporate that into my next policy. And there's the lump sum method, taking a ton of cash and dumping it in as PUA, and then having an annual premium that I'm comfortable with. I don't really like that option for me at this point. Mm-hmm. What I'm going to do, and we've talked about it in a few episodes, is this: some of these companies have these premium deposit fund riders. And right now, some of these riders are paying the equivalent of like a 5% interest rate. And the way it works out, it basically gives you more bang for your premium buck. And if you want more details on that, you'd have to talk to us and we could go over that. It doesn't apply to many people, but if you're selling a business or you've got a large exchange to make, maybe from another company, maybe you could do those things. But my idea is to take this windfall and just prepay 10 years of premium at some level, whatever that amount is per year, for up to 10 years. And that's going to give me a tremendous discount on the amount of, the premium I'm paying versus the death benefit that it's producing. I'm getting a huge discount for doing that premium deposit fund rider. But I'm also designing a policy that I know I can handle year 11, year 15, year 20, and so on into the future.
Yeah.
So if folks, so if your windfall, let's say it was 100,000 or $1 million, and I'm just going to make up numbers here, but let's say you had $1 million windfall. Well, not too many people, right, that we deal with can afford $1 million per year of premium. Maybe they could do it one time.
Right.
So a way to get that $1 million windfall, maybe you had a loved one pass away or a great aunt that left you a ton of money. You could break that into a 10-year period, let's say, of $100,000 a year of premium, or $10,000 if it was $100,000 windfall.
Exactly.
And that way you can set a comfortable premium that meets your goals, and you get more bang for your premium buck.
And it's kind of, you set it and forget it.
Yes.
And then by time that 10 years runs out, year 11 comes around and you have to pay that premium out of pocket. Your dividend is already creating enough, is kicking off enough that, one, you could use the dividend to pay the premium, but
in a pinch, sure.
In a pinch, but guess what? 10 years from now, are you going to be making more money? Is that premium going to look a lot smaller than it does today? Absolutely. Right? Unless something terribly goes wrong, you do some really bad planning in life, you should be making more money 10 years from now than you are right now. Right?
I concur.
So plan for that. So now you're planning for a windfall by having that convertible term policy. So when you get that windfall, you could put it all into a premium deposit fund. So basically pay 10 years of premium with that one lump sum. And now you're also planning for the future, because 10 years from now, you'll be making more money. So now you've just created another place for more of your capital to go when you are able to actually start funding that out of pocket.
Yeah. And the other thing is that money is liquid. If I needed to get to that massive lump sum, I can get to it. Right? So it's not locked up in like a qualified plan, like a 401k or something. Right?
It's liquid in the sense that if you needed it, you could take it out. You just can't put it back in.
I just can't put it back in. That's correct.
So then you start paying
and I lose the benefit of having it in there, right? So
yeah, you lose the discount and all that. So
right.
But I mean, it's kind of nice, out of sight, out of mind. Way better than just letting that money sit in a bank account somewhere and you stare at it. You hate it because it's doing nothing for you. It's at risk, all those
Let's
things.
think like the money's in motion. Either I'm going to put some of that capital to work doing something, or a life insurance company, a mutual life insurance company that I part own, is putting that money in motion because maybe Dave needs it, or
Right.
maybe you need it via policy loan, right? So it's being put in motion for me, regardless if I'm putting it in motion myself, right?
And guess
So,
what? It's still creating cash value that you have access to.
yep.
Every single year, you got more cash value that you could utilize if you want to or need to. So I think that's great because I mean, yeah, if you do that with your windfalls, there's not a whole lot else you're going to need to do. You certainly don't need to take risks.
Right. And part of that windfall, I guess I didn't say this, part of that, the dollar amount that I'm thinking of is my future tax bill that I'll pay before the extensions. I think you have to pay your personal by like mid-October or something.
Yeah.
I think is right. I think it's business is mid-September.
Yeah.
Personal is mid-October. Anyway, part of that money is the money I'm going to have to send to the federal government.
Yeah.
Uncle Guido.
Uncle Guido. Yeah.
I don't know what he does for me necessarily. I mean, I guess he pays your paycheck, Paul. Like,
He
For
doesn't
now.
pay the paycheck. The taxpayer does.
I pay it.
Yeah. You help fund your own paycheck.
Y'all pay it. We all pay it. Yeah, that's right. Anyway,
Anyway, that's cool.
So that's yeah. But
Yeah.
putting some
And-
thought to it. So
Yeah. So great for somebody expecting a windfall and who's very conservative and just wants to do something really conservative, safe, but still keep that money in motion and earn something on it because you are earning
and never
on it.
pay tax on all those dollars ever again.
Exactly.
What's that
Ever
worth?
again. That's huge. Well, so let's talk. Let's change gears, switch gears here a little bit, and we came across this pretty cool quote, apparently by George Foreman. He said, "The question isn't at what age I want to retire; it's at what income." So, I mean, this guy got punched in the head for a living, but even he's smart enough to realize there's nothing magical about a certain age that means I'm ready to retire. It's the income because what do you only need one thing to retire? What's that?
Income.
Income. So what income do you want to retire? So I don't know how magically at 65 you all of a sudden have the proper income that you want. Maybe you had it at 62, but you just had in your mind that I'm going to 65 because that's what I was told to do.
Yeah, they get a little bit more Social Security if they don't take it, at 62.
Well, you can retire without taking Social Security.
That's true, but I think a lot of people are factoring. I think this conventional planning that everyone's in with their CFP or their advisor, whoever, and this is fine, but it's not part of our plan. I know that because it's insolvent. I mean, I don't know how, other than printing money to prop it up, I don't know what the plan is. But I think in 2034, 35, it's supposed to run out of money.
Yeah. Well, okay. So instead of like Paul and you and I don't have a retirement plan. We have an income plan.
Yeah.
So I'm never going to retire. Like Nelson Nash says, why would I retire? Like build a life you don't want to retire from. Like
Right.
if you enjoy what you're doing, why would you retire from it? Why would you put yourself out to pasture if you actually enjoy it? So here's a few questions that that you may want to use to analyze your income plan. You can substitute retirement plan if you want, but that's not the words we're going to use. We're going to use income plan. What's your income plan? So how about the first one? What's, one of Nelson's biggest rules is rethink your thinking. So does your thinking currently promote scarcity or abundance? Scarcity might be, I've got to pinch pennies. I've got to not live my life today because I got to accumulate it for retirement. And then once you get to your passive income years, retirement, then it's pinch and penny so you don't run out of it. Is that the kind of mindset you want to live with for the next 20, 30 years until you get to that point, and then for another 30 years during that time?
No, I think I want to live like my in-laws, man.
How's that?
Just, they do whatever they want.
Yeah.
Like
Why?
Because they had a good income plan.
Nice.
I think my father-in-law he took a buyout from the phone company. He used to work for Bell, I think, Bell South or Bell North, whatever, telephone company back in the old days. He fixed their trucks. And as he was getting more, he was a mechanic, and as he got more senior, and toward the end of his, prime working years, he took a buyout, stuck that in like a deferred annuity at 4 or 5%, and didn't touch it for 20 years maybe, and it just kept chugging along and increasing in value. And now they take a good amount of income off that every month. They don't even touch the money though. They take the income.
Yeah.
They don't even need it because he has a pension from the National Guard, and both have Social Security, whatever, and they live very well. They go to Sandals every year, go scuba diving, and they're in their 70s, right? They still scuba dive. And
Wow, that's cool.
they're really amazing. They do whatever they want, and they live on their boat in the summertime.
Yeah.
Up in Block Island, for those of you from New England that know, it's a great place.
That sounds fun.
And they're middle class people, blue collar people that just did it right.
Yeah. And we have a couple episodes on just rethinking your thinking early on, like, the middle class mindset.
Yeah.
It starts with a mindset. So yeah, one thing I've done in the last, it's probably been maybe 7 years since I kind of reframed my thinking to abundance. I'm going to focus on increasing my income instead of decreasing
Just being
my
so
expenses.
cheap all the time.
I'm still cheap. Don't get me wrong. But my focus now is not on how much money can I save. My focus is on where can I increase my income? How can I increase my means? Because then I can still be cheap, but it doesn't hurt so much emotionally and financially to spend money.
Right. You deliberately changed the way you thought.
It was deliberate. That's a good word.
Yeah.
It's not going to happen by accident. You have to make an effort, and you have to keep going back to it because it's real tough to retrain your mind on something that has been ingrained for like 35 years it was or more. So, yeah.
Yeah. So, it's like live within your means, but why not figure out ways to increase your means?
Yeah, exactly. Increase them. And then with that increase, save it, put it away, open a new policy, right? Expand your system. All right. Next question. How does your income plan affect your personal economic situation? Does it improve it or does it not improve it? So, if your income plan is to put money away into money prison or something, where you can't touch it, you can't do anything with it, it's up to somebody else to make it grow. Does that really improve your personal economic situation right now or not?
Well, I could tell you from personal experience that locking money up, and I think we're going to pick on the 401k here, instituted in 1978, and now seen as like an incentive for employers to offer their employees, like automatic enrollment. Look at this, we do a 5% match or whatever, and that's fine. Or maybe you're an airline pilot and we pay your entire, we'll contribute 16% of your salary, which is what a great advantage for those guys.
Yeah.
Sign me up. I would take, it's free money. It's part of my comp, I guess, right? It's kind of like almost like a deferred comp.
Not that's free money. They're working for it, but
yeah, they're working for it. No doubt.
Yeah.
No doubt.
Yeah.
But, this almost ties into the next one, I think, too, is that.
Yeah. What is it?
Is opportunity cost. When you're in that employee, Kiyosaki talks about that, right? But you're in that employee mindset where it's like, I set this 401k and I forget it. It comes out automatically out of my paycheck every month. And that could be the same thing for my private IRA that I have on the side as well, that my financial advisor got me started in. That's all, whatever. That is what it is. That's what everybody's doing. But now you're not looking for anything else, probably.
You know what? It's very passive. I think everybody desires passive income, right?
Yeah.
But most people, the way they try to attain passive income is by passively investing and passively saving. And by passively, I mean it comes out automatic and you don't even see it, which means you don't even think about what that money's doing.
Nope.
Because it's like it doesn't even belong to you, because technically it doesn't. But
It's trying to get at it.
your passive, you cannot create a solid income plan with passive income by passively investing and passively saving. You have to be active. Because if you're not active, your mind won't be active and you won't be engaged and you won't take ownership in it. I mean, I think that's been huge in my life, that I create these policies and I have to actively go pay that premium.
Yeah.
Which means I have to actively plan to have that money available to pay that premium, because I know eventually that's going to create some very passive income, a whole lot of passive income for me down the road.
Yeah, let's talk about that real quick, because I got excited about that earlier. Is that a lot of people don't understand, and we just talked about it earlier, like the cash value increase in my sixth premium that I'm paying on our original policies that we bought from you.
Mm-hmm.
The amount of cash that policy is now throwing off is tremendous. And next year it breaks even, which is great. Those 2015 policies were fantastic. Anyway, but later in the policy's life, when it's 20, 30, 40 years old, and every dollar in premium is producing $2, $3, $4 of cash value, yeah, the American public is completely oblivious to the passive income qualities of dividend paying, participating whole life. They have no idea of the tremendous amount of tax-free income. The way we use these policies, right? We could take tax-free passive income in perpetuity until the day we die off these policies.
Yep.
If we've at any income level relative to the premium that's been paid. So a little bit of premium, a little bit of tax-free passive income.
Yeah.
Big premium relative to your income, and everyone's different. Big passive income.
There you go.
Tax-free passive income relative to premium paid. So, gosh, I wish more people would explore at least just that. Just because this is a whole life insurance policy and it's not considered, nor do I want it to be, a tax qualified plan created by the government who really cares about me.
Yeah.
It has better qualities than those products, and I can get to the money right now.
Absolutely. So what's the opportunity cost of your income plan? Are you putting away money right now that you can't access for opportunities, emergencies, whatever?
Construction loan, down payment.
Down payments to build a dream home, retirement home, right? Or, are you putting your money somewhere that you still have access, you still have control, you still have liquidity, you have
uninterrupted compound interest?
Boom. Yeah.
That's pretty nice.
There's an opportunity cost anywhere you put your money. So what is the opportunity cost of where you're currently putting it to in your income plan? What about this? Does your income plan result in the stagnation of capital or the flow of capital?
Yeah, I think for most people, not our listeners per se, but most, your typical American, yeah, they have, it's stagnant to them. Other people are making a killing off of it.
Oh yeah. Yep.
Right? State Street Bank, BlackRock, Vanguard, Fidelity, whoever.
Any bank, really.
Any bank.
They always got the biggest buildings in the city, right? With their name on the tallest skyscraper there is.
Yep, that's true. We were just up in Tyson's, and there's a big Capital One building up there.
Yep. So there you go. Money needs to, much like water needs to flow to be of any use. If it's
stagnant, it's gross.
Yeah, to be of any use, just like money needs to flow. Ideally through your own personal economy and not somebody else's. In either case, money's going to flow.
Money's going to flow, whether you're involved, if you're in the middle of the river or not.
Exactly. Yep. All right. So kind of leads to the next one. Who's in control of your income plan? Do you have any control at all other than, say, funding it or not funding it?
Yeah. So no, I mean, most people, again, they don't. They have if you're a big 401k person in the thrift savings plan for government and military, you have a sweet spot between age 59 and a half and age 72 or 72 and a half. I can't remember if they moved it again.
Still 70 and a half, as far as I know. Maybe they moved it to
Is it?
72.
I thought it was 72.
Maybe.
Now, but anyway, you have
Or yeah, you're right,
basically a
72.
12 and a half year period where your money is not in some sort of penalty phase, and I'm talking about traditional money, traditional IRA money. Outside of those windows, you're in a penalty phase,
Yeah.
either before 59 and a half or who pulled the rule of 55? Like, yeah, I know. Exceptions for everything, isn't there? Or, after age 72 where you have to take RMDs. So
Yeah.
anyway,
Yep. Who's in control?
why would you want to put money there?
Yeah.
I'm not really sure. Other than they dangle the match over you and you lop it up every time.
Yep. Now, I'm going to rewrite this question that we wrote down, but is your income plan, does it create income or does it just accumulate capital that you're going to deplete over time? Is it the accumulation theory where you build it up just to tear it down? Or are you accumulating something and creating permanent wealth that's going to pay you over time or in later years?
Yeah. It'd be interesting to see, your typical 65 to 75-year-old when they're hitting this phase and they've done their conventional accumulation stuff where they're
So we just ran
money.
numbers before this. So like if you do $500 a month from age 35 to age 65, right? That's 30 years of doing $500 a month at 10% uninterrupted compound growth, which is what they preach. Hey, Dave Ramsey's going to tell you can earn 10%.
compounding annually is
Yeah, compounded annually. So basically, by his math, if you put $500 a month in for 30 years at 10%, you're going to have $1 million. You're going to be a millionaire. And I challenge you. How many of you have been doing this regularly for a number of years, maybe 10, maybe 20 years? Like, do you have the accumulation that you thought you would have or that you were told you would have by this point?
I could tell you mine, and I was a passive investor, if you want to call it that. It's really saving for retirement in a securities environment, TSP and Roth IRA that was funded through mutual funds most of its life, right? And so I was your typical employee in America. Let's face it. And my math, this was not counting taxes because taxes haven't been taken out of TSP yet because it was traditional money. So I was deferring taxes to a later date, unknown tax rate in the future. And I think I was, and I had mostly been in the C fund for those of you that know that historically the highest returning fund. And I was at like 5.58% roughly.
Wow. Before taxes.
Before taxes.
Okay. So
it wasn't the 8% or there were some bullish years in there.
sure. Yeah, you're going to see some
Bullish.
big years. But it's kind of funny when you take the actual rate of return over all those years and see what it is.
Yeah.
Like the average,
Because
the
I never-
average means nothing. We've discussed that before. The average
Yep.
rate of return is garbage. Don't even pay attention
Garbage.
to it.
This was actual. And I was just like, well,
Yeah.
and I didn't, actively manage it too much where, okay, the market I think has peaked. I'm going to take it out, put it back in the guarantee G fund, for example, government bond fund, and then wait for the market to crash, put it all back in and then ride the wave back up. I never really did that. I did it one time and it was great. But I suspect that most people are in that kind of cruise control, whether it's a target date fund that are stupid.
Again, it's passive. And most
Very
people
passive.
aren't checking their statements every month. They're not paying attention. They're just saying, well, I'm assuming this is working for me and it's gonna be a good thing for me. It's a lot of assumptions.
But I do know on the statements they started to provide, as it got more advanced, they started to provide like an estimated income if you started taking, like, if you annuitized the account as it stood, right now or at age 60 something, it would, assuming this rate of return, whatever, it would return this much income every year or every month or whatever.
Yeah.
I think it was monthly. And I'd look at that and be like, oh wow, not enough to live off.
No.
And I've been putting, so that example of the $500, there's no way that's even close to being true
Yeah.
for
No
most
way.
for most people.
Right.
For you advanced people, okay, maybe, but for most people,
Well,
not
it's
even
kind of
close.
kind of funny. The numbers you calculated was close to 6% before taxes were taken into account. If you do that, like you talked at the beginning, putting that big lump sum into a policy and to the PDF, the premium deposit fund rider, you're going to make 5% every year on that, completely tax free. Like,
Well, no.
oh no,
that's
you're right.
taxed
You
a
do
little
get
bit.
taxed on the imputed income.
It
Okay.
is, and
That's-
but it's
Yeah,
minuscule. I mean, it's going to be minuscule. But then but the growth on that, right? The year
Yeah.
11, year 40, year 50,
yeah,
all of that will never be taxed again. So I
Right.
am paying a little bit of a tax on because it's like
because you
everybody
have to be
getting
taxed
5%.
on what that savings was. So the 5% savings is going to be added to your taxable income.
Right. But when I show myself the math, and I've illustrated this to myself, it's tremendous. Like
Yeah.
you don't even care. It's because it's the amount of bang for your buck. I keep saying that, but that's the best way I can describe it is tremendous.
Yeah.
It's
So if
really
you've got
exciting.
a big lump sum, a big windfall right now that you want to put away and kind of out of sight, out of mind, and just let that work for you, you need to look into this.
Yeah, and big is relative.
Exactly. Just like you said, you mentioned $1 million, then you said 100,000. Maybe it's 40,000. Man, then
Big is relative.
Yeah, exactly. Maybe it's 50,000. You do 5,000 a year for 10 years. So
Correct.
Yeah, you could do it with 50.
relative.
So exactly, it's all relative. Okay, and then finally, how about here's a big one, and here's where I don't think anybody can compete with IBC is how many jobs can your capital do in your income plan at the same time?
Probably one.
Probably one, unless it's in a policy. Then it can do multiple at the exact same time
Multiple.
because you're getting uninterrupted compound growth, even as you're leveraging that cash value to borrow money to do anything else you want to do with.
Oh, and I still get the full dividend? at the
Always
end of the
compounding
policy
in the
year?
background.
Yay.
Yep, that's right. If
Amazing.
you use the right
Oh,
companies.
There's no tax.
Yep.
Oh.
Yeah.
Oh, it's private?
Yep. There
I
you
love
go.
the attributes of dividend paying whole life.
Me too.
It's
It's
what a tremendous asset.
yeah. We could talk for 100 episodes about this and never get bored.
Yeah.
Oh,
Hey,
oh wait.
we have.
We have 113. All right.
This is
Well-
113, right?
It sure is.
Yeah.
Yeah. All right. Well, that's good. That'll sum it up. We went a little bit long today. Hope you listened faster so it got done in 30 minutes or less. Anyway.
Sound weird though if you go too fast. It kind of sound like the chipmunks.
Yeah. Well, I talk faster than you. So I talk a lot faster at 1.25 speed. You talk about my speed when I'm at 1x.
Trying to
I know because Hannah listens.
I'm
every
moving
once
to
in a while.
East. I'm moving to East Tennessee, so
You're gonna start talking a lot slower.
I'm gonna just talk slow and
We're gonna have to tell
Like this.
the guys to edit the audio, speed yours up, and keep mine the same. Yeah. Well, all right, man. I'm gonna get to dinner.
sweet.
So, all right, sounds good. Everybody have a good week, and until next time, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.